Hi there, welcome to kneppyinvests. One of the things I like to do is to challenge some of my biases, and I did that in two videos in the past 2 weeks when I chose 10 companies at random in the ASX 100, and I had a look at their financials, their valuation, and the charts just to see if my biases hold true. Those videos were quite popular among viewers of this channel. Not only that, I actually did like doing those videos on those companies because I learned a fair bit about some of those companies and also about my own investing strategies. So I've decided to go down this path again, but instead of choosing 10 random companies on the ASX 100, I'm going to choose 10 companies at random that are in the ASX 200. I'm going to do exactly the same thing. I'm going to look at these 10 companies' financials, the valuation, and the chart, and I'm going to test my biases I have against all 10 of these companies. So let's look at the first 5 companies that will feature in this video, and I'll talk about my biases I have either for or against these companies. Before I talk about why I am or have a neutral, negative, or positive bias against these 5 companies I'll be featuring in this video, I should talk about my own investing strategies because that's very important to how you develop biases for or against companies. I tend to look for companies that are growing. Some people might call that growth companies, but all companies should have aspirations to grow through time. So I will be looking at the history of revenue, profit, and operating cash flow. And if they aren't growing through time, in my opinion, that company is not an investable company according to my own investing strategies. And sometimes I will have an opinion or a bias for a company, and that bias or that opinion could be completely wrong. And that's why I want to test these biases in this video. So let's get into it and talk about my biases for or against some of these companies. First company I'll be looking at is Breville. Now, I was thinking of not including Breville in this video simply because I am an ex-shareholder of this company, and I do know Breville has been growing over the past 10 years. My only question when it comes to Breville is the valuation, and we'll test that in this video. The next company is Aventus. I know very little about this company, but I do know they are an owner, manager, whatnot of 19 retail centres in Australia. And just that little fact, I am slightly biased against those sort of companies because I don't think there's much growth in owning and managing retail centres, particularly in the suburbs. And that is what Aventus, or that's where Aventus Group's retail centres are located. IPH Limited, IPO'd or listed on the ASX 2015. They had a very stellar start to their listing. Share price appreciation was quite significant in the first year they were on the ASX. You'll be able to see that on the chart. I did a little bit of research on the company in that first year, and after that, I've paid very little attention to this company. And one of the main reasons I didn't expect significant growth for IPH. I thought if they did have growth, it would be quite weak, quite slow. So we'll be able to test that assumption in this video. And then the next 2 companies, I have very anti-bias against them. And that includes Woodside and the Star Entertainment Group. I have an opinion that both these companies are not growth companies. They aren't growing their revenue, aren't growing their profit or cash flow, and thus are not investable companies for me. In fact, I have not looked at either of these companies at all over the past 10 years. The only reason I might take a position either of these companies is if I look at the valuation based off their historical levels, and they do look quite cheap. So it would only be a short-term trade. That's the only reason I would buy a position in either of these 2 companies, and it would only be a short-term position, not a long-term buy and hold. So let's test these biases to see if they hold true, and starting with Breville. Because I am an ex-shareholder of this company, I do know straight away that Breville has been growing over the past 10 years. So let's have a look at the growth of this company during that time period. The market cap has grown from 429 million in 2011 to 4.0 billion right now. That's at a share price of $29.31. That's an almost 10 bagger in the past 10 years. And then look at some of the financial metrics: revenue, profit, and operating cash flow. And we have seen significant growth over that period of time as well. Revenues tripled, profits almost tripled, and operating cash flow has increased 5 times from 27 million to 124.4 million. This is definitely a growth company. Even if you look at return on equity, it's around 20%. It slipped a little bit over the past 10 years, but it's still at 19.2%, which is a good number for a growth company. Company also has net cash. That's a big tick in my books. I'm always looking for companies with net cash, definitely preferable over companies with net debt. But once we get to the valuation metrics, this is where, and the reason why I decided to sell out of this company a little while back. Price operating cash flow, 32.2. So what I'm going to do is look at these valuation metrics and compare it to what you typically see it for a company. For instance, Breville's price to operating cash flow typically falls between 4 and 30. And the reason there's a large range there is because if we go back 10 years ago, the market didn't really believe in Breville. And the reason we know that the market didn't believe in Breville is because the valuation metrics were really low back then. Price operating cash flow was in the single digits. P/E ratio was towards 10. And the price to sales ratio was around about 0.3 to 0.5. The market did not think Breville would grow in the future. And sometimes the market can be wrong. And it was definitely wrong when it came to Breville back in 2011. But right now, these valuation metrics exceed the typical levels you find for this company. And that's why I do think the valuation of Breville right now is a little bit stretched. So either the market expects you to pay a premium for this company's shares, or the market expects Breville to accelerate its growth over the next few years. And in fact, it has done that over the past 5 years. And I'll show you that in the next slide. For all growth companies who has seen their share price increase over the past 10 years or 5 years or any period of time, I want to know why the share price has increased. Share price can increase through 2 reasons. Financial expansion, so that means revenue, operating cash flow, profit have increased through time, and multiple expansion. And the way to look at multiple expansion is if the market is willing to pay more of a premium for that company. Or another way to look at that is the P/E ratio or the price to operating cash flow, price to sales ratio, are they increasing through time? That is multiple expansion. And the way to test whether a company's share price appreciation is through financial expansion or multiple expansion, all you have to do is compare the growth rate of revenue, operating cash flow, and profit to the growth in market cap or share price. A lot of times, the market cap and share price should be almost identical if the company hasn't been doing any capital raising. Sometimes you will see a difference between those two, and that means the company has been doing either share buybacks or has been doing some capital raising. Now, once we get to Breville, I've broken it down into 2 periods, from 2011 to 2021, and then the last 5 years from 2016 to 2021. So we can just see if the financial expansion has been accelerating. And for Breville, it has. But let's look at the period between 2011 and 2021. Revenue, operating cash flow, and profit all were growing between 10 and 11% per year. So if there was no multiple expansion, if the P/E ratio, price to operating cash flow, price to sales ratio were not increasing through time, they were just staying at the same level, we should expect the market cap and share price growth to be between 10 and 11%, but it's not. The market cap has been growing at 25.5%, share price at 25%. That means there has been some multiple expansion happening over the past 10 years. It means the market is telling us you need to pay, or we need to pay, more of a premium for Breville's shares. Or another way to look at it is potentially the market is expecting Breville to be accelerating its financial metrics over the next few years. Now, if we look at the period between 2016 and 2021, revenue, operating cash flow, and profit have increased. They have accelerated. Revenue is now increasing at 15.6% per year, operating cash flow at 19% per year, and profit at 12.7% per year. But the markup and the share price have also accelerated and now are growing between 32 and 34% per year. So one of the reasons why Breville's share price has been increasing is there has been some financial expansion, but it's also because of multiple expansion. And in fact, when you are owning a company's shares, the best thing to see is when the share price is appreciating because of the two, because of financial expansion and multiple expansion. But you do have to be wary because that means there's a little bit more hype in the shares. And it needs to justify that hype in the long run by accelerating its financial performance. So that's one reason you do have to be wary about companies where you do see a lot of multiple expansion. As we turn our attention to Breville's 10-year weekly chart, this is exactly the sort of chart you want to see for a company you own over the long term. Breville is without doubt the sort of company you want to own in your long-term buy and hold portfolio. And it could be a mistake that I did sell out just because I think the valuation is a little bit too stretched. And whether it is a mistake or not, we won't know for another few years. But I am looking at taking another position if the share price does pull back a little bit, particularly towards the 200-week moving average. So in this chart, I have included 4 weekly moving averages, the 10, 20, 50, and 200-week moving average. The 200-week moving average is the orange line right at the bottom. And typically, the Breville share price stays above that 200-week moving average. It has fallen below it on occasion for a short period of time, back in 2015, 2016, and then again during the COVID-19 financial panic. But every single time it falls below that 200-week moving average, we see the share price rebound and move back up again, up past it. The other thing is the 50-week moving average tends to be another good support level for this company, and that has definitely held true since the COVID-19 financial panic. Every single time the share price of Breville moves towards the 50-week moving average, we see the share price bounce again. It did it a few weeks ago. The share price of Breville moved to $27, and we saw a really good bounce, and in fact the share price went from $27 to $30 in a fairly quick fashion. So what I'm doing now with Breville is just waiting, being patient to see if we do see a significant pullback in the share price towards maybe 22, 24 would be the best case scenario towards a 200-week moving average. But if the share price moves back towards $27, $28, I could think about taking a position at that price level. So just being patient with Breville. I do think this is a potential long-term buy and hold. It's just the valuation right now that I'm a little bit wary about. But it could be a mistake, particularly if Breville accelerates its financial growth. Onto the company I know very little about, and that is Aventus Group, ticker code AVN. Apparently, Aventus Group is Australia's largest fully integrated owner, manager, and developer of large format retail centres. The way I look at that, and I did actually go to their website, looked at all their properties. They have 19 properties throughout Australia, and it seems like most of their retail centres are those small suburban centres where you have the main tenant, say maybe Good Guys, Bunnings, Harvey Norman, and then it's surrounded by these other smaller tenants. So one of those retail centres where you might go just to see JB Hi-Fi or Freedom, and their 5 largest tenants in terms of rental income are Bunnings, Good Guys, Harvey Norman, JB Hi-Fi, and Freedom. Now, because they are a retail centre owner and manager, right then I am biased against those sort of business because I don't think there's going to be significant growth in that area over the next 5 to 10 years. So I am just naturally biased against Aventus Group because of what they do, not the company itself. But if we look at some of the financials of this company, since they listed on the ASX in around 2015 or 16, it does look quite promising. So potentially this company is challenging my biases. The markup has grown from 930 million in 2016 to 1.9 billion right now. So the valuation of the company has doubled over the past 5 years. And if we turn our attention to revenue, profit, and operating cash flow, we do see growth there, but you do have to be wary about the profit. Talk about that in a second. Revenue has grown from 77 million to 174 million in 5 years, and operating cash flow has almost tripled from 31.7 million to 113.9 million. Now, you might look at profit and say, wow, this company is really growing strongly because revenue has grown from profit has grown from 51 million to 409.7. But you do have to be a little bit wary there, because one of the reasons their profit does seem quite large is because there was a net gain on the fair value of their investment properties, and that net gain was 297.3 million. That's not something that will continue over the next few years. It's just a really one-off net gain. In fact, last year they had a net loss on the fair value, which did lower their profit. So take that profit with a grain of salt. And also, because you have to take that with a grain of salt, the P/E ratio looks really low at 4.6. That's because that profit has been inflated by that net gain on fair value. Their property value is at 2.2 billion, which does exceed their market cap, but they also have $700 million of net debt. Now let's have a look at the valuation of Aventus Group. And what we're looking for here is price to operating cash flow, price to P/E ratio, price to book ratio to be lower than historical ranges for this company. And apart from P/E ratio, which I've already mentioned, is a little bit too low than it should be, the valuation metrics for this company are in their historical range. In fact, the price to book ratio is at the top end, and the price to operating cash flow is just above their historical range, which is telling me that Aventus Group is fairly valued and maybe slightly overvalued right now. So I wouldn't be buying this company based on valuation reasons at this point in time. If we take a look at Aventus Group's weekly chart since they listed, nothing really happened for this company between 2015 when they listed and towards the end of 2018. Share price just went sideways. In fact, when they listed, the share price was $2, and by the end of 2018, the share price went back to $2. Then we did see a bit of an appreciation in the share price in 2019. In fact, the share price went from $2 to $3. Nice little 50% gain. But this company was hit hard because of the COVID-19 financial panic. Share price fell from about $3 all the way to a low of $1.35, which makes sense because you would expect retail centres to be hit hard by lockdowns, that sort of thing. So the significant decrease in share price does make sense for this company. But the recovery in the share price, the V-shaped recovery, has been stellar, has been amazing for Aventus Group. Share price has moved from $1.35, the low, to a current share price around $3.50. And the share price right now is in a well-defined uptrend and near an all-time high for the company. So there are many things going right for Aventus Group. We have the share price in an uptrend at an all-time high. The company has grown its financials, doubled some of its financial metrics over the past 5 years. Maybe the only slight negative thing about Aventus Group is just the valuation. It does seem like it's higher than what it should be based off its historical rate. So Aventus Group does look interesting. It's just the sector it's in, which is holding you back from taking a further look at this company. Next company we're going to look at is IPH Limited. This company is all about intellectual property. So if you have any issues in that regard, maybe this is the company for you. I believe they have offices in Australia, Singapore, Southeast Asia. I'm not exactly sure on that because the last time I did research on this company was back in 2015 or 16 when the share price tripled from when they listed. A lot of hype in this company, but that hype has waned away over the last few years. And there are some issues I do have in regards to the growth. Even though this company is growing, there are some issues. The markup has grown from 763 million just after they IPO'd to 1.9 billion, almost tripling over the 6 years or the last 6 years. But when we look at the growth in revenue compared to profit and operating cash flow, this is where I have a bit of a problem with this company. Revenue has quadrupled over the past 6 years. And if revenue has quadrupled, the least we should expect is that profit and operating cash flow to at least quadruple as well. If it hasn't, that means some of the margins in this company have fallen. And when we look at profit, it hasn't even doubled. It's grown from 30.3 million to 53.6 million. That's actually fairly slow growth, particularly when you compare it to the revenue growth. And even the operating cash flow has not quite tripled over the past 6 years, growing from 31.6 million to 92.6 million. So the margins in this business have been affected over the past 6 years, and that is a problem I do have with this company. They have net debt of $40 million. That's not an issue. And when we look at some of the valuation metrics right now for this company, they're either within the range to what we should expect for this company, or in regards to P ratio at 35.4. That is higher than what you usually see for this company, where the typical range for P ratio is between 20 and 30. Price operating cash flows at 20.5. Price of sales at 5.3. Just looking at the valuation metrics right now, IPH does not look attractive, particularly because profit hasn't been increasing all that much over the past 6 years. Now, if they can turn around their margins, start growing their margins, this company would start looking quite attractive at these prices. And we can just see how hard IPH has found converting their growth in revenue to the bottom line profit. Revenue has been growing over the last 5 years at 20.8% per year. That's really good growth in revenue. But operating cash flow has only been growing at 17.1%. And profit over the past 5 years has only been growing at 6.7% per year. And this is all because of decreasing margins. And that's why I said if they can start increasing the margins and translate more of that revenue to the bottom line to profit, this company would be looking quite attractive right now. And the reason it'd be looking really attractive is because the market cap of this company, or the value of this company, has been increasing at the same rate as the profit, and the share price has only been increasing at 4% per year. So again, the valuation of this company has been moving in line with the profit. So if they can turn more of that revenue growth into profit, we will see, or should see, the share price starting to accelerate. So we'll be leaving this company on my watch list. I'll be paying close attention to the margins of this company. And if they start improving the margins, that's when you might take a position in this company. Now let's turn our attention to IPH's weekly chart since they listed on the ASX way back in 2014, looks like the end of 2014. I've already mentioned that there was a lot of hype in this company in the first year they were listed on the ASX. In fact, share price increased from $3, or just below $3, all the way to a high of about $9.50 in about 1 year of trading. So the share price tripled in that first year. Again, that's why I did research on this company, why there was a lot of hype around IPH during that period. But then that hype waned away fairly quickly, and the share price fell all the way from that high of $9.50 all the way back to its IPO price of about $3 at the start of 2018. Now, when you look at this chart, you'll notice the share price starts at the bottom left and has finished or moved to the top right. And that's exactly what you want to see for a company you hold. But unlike Breville, where there has been a smooth transition from the bottom left to the top right, there's a lot of volatility in IPH share price. It goes up and down in wild swings, and some of these wild swings can take about a year or 2 years to play out. And right now, we're at the top of a potential upswing, and who knows what's going to happen over the next few years. We might see a share price fall all the way back to the $3 range. I'm just going to leave this on my watch list just to see what happens with the margins over the next few years. And if we do see the margins start to increase, that could be the catalyst for us to buy or take a position in this company. The last two companies I'm featuring in this video, I definitely have some bias against, because when I think of the names Woodside and Star Entertainment Group, I instantly think this is two companies that aren't growing right now and are definitely not investable companies for me and my investing strategies. So let's test these biases to see if they are true. And the first stop is Woodside. Their code is WPL. And the first stop we're going to make is looking at the markup and what's happened over the past 10 years for this company. And it's not a good start. In fact, the markup for Woodside has fallen from 24.7 billion in 2011 to 22.7 billion right now. And that means more than likely the share price has fallen over the past 10 years unless they've done significant share buybacks during that period. More than likely they have not. So that's not a good start for this company. Now let's turn our attention to revenue, profit and operating cash flow. And we want to see some growth in these metrics. And we do see a little bit of growth in revenue and operating cash flow. Revenue's grown from 4.7 billion to 5.6 billion, not significant growth. And operating cash flow has grown from 2.2 billion to 2.7 billion. But profit's fallen from 1.5 billion to 466 million. You do have to take that with a grain of salt because more than likely there were some one-offs in the past 12 months. So I haven't told you this yet, but this is looking at the trailing 12 months, not at financial year 21. So a little bit of growth in revenue and operating cash flow, but not significant growth. And the net profit after tax, you have to take that with a grain of salt. And also when you look at the P/E ratio, because more than likely some one-offs have decreased that profit, the P/E ratio is at 48.7. That looks really high for a non-growth company, but again, that's been influenced by that lower than should be net profit after tax. You might have to look at underlying profit instead of the reporting profit. And I even said in the P/E ratio, historical range is all over the place. If you look at 1 year's P/E ratio, it could be anywhere from 48.7 all the way as low as 2, simply because profit just oscillates up and down because of one-offs in every single year. $2.5 billion of debt. That seems fairly high. They even have leases of 1.1 billion. One thing I haven't mentioned, Woodside spends a lot of money on capital expenditure. So in a way, they are spending money not to grow. $3.5 billion in 2011 and $1.9 billion in this year, financial year 21, actually the trailing 12 months. So they are spending money not to grow. They are spending money just to maintain where they are right now. Price to operating cash flow, 8.4. That's in its historical range. And P/B ratio at 1.4. Again, that is in its historical range. The only reason I would buy Woodside is if I do see some good value there. And then, even then, I'd only hold Woodside for a very short period of time until the value gets back into its historical range. And right now, valuations are in its historical range, so I don't see any value at this point in time in Woodside. I don't want to linger too long on looking at Woodside's weekly chart over the past 10 years. It looks quite ugly. We already know the value of the company in terms of markup has fallen during that period, which meant more than likely share price has fallen. And in fact, the share price has fallen by more than the valuation, dropping from about $40 to $41 to a current share price around $23. And the reason why the share price has fallen by more than the market cap is simply because Woodside have done capital raisings over the past 10 years. They've diluted the shareholders during that period. I'm not sure why anyone would be having this company in their long-term buy and hold portfolio because there's no growth in this company. My biases have held true. I thought this company isn't a growth company, and it's definitely true. No reason to linger anymore on this company. Just like I have some negative opinions about Woodside, I also have some negative opinions, some negative bias against the Star Entertainment Group. Firstly, I don't think these are investable sort of companies, these companies that own casinos. And I do have some questions about the ethics of these companies because I don't think we should be promoting addictive behaviors. And gambling for a lot of people can be quite addictive. Now, gambling can be okay if you are able to control it, but a lot of people's lives and families are destroyed because of gambling. So we do have to be careful, and because a lot of casinos try to promote gambling and they don't really care that people spend all that time at a poker machine, putting all the money, losing all the money. They don't seem to really care about that sort of thing. I could be mistaken. Now, in saying that, last time I was in Las Vegas 4 years ago, we did stay at the Bellagio with a view of the fountain. If you know the Bellagio fountain, it's an amazing experience. And to be able to see that was incredible. And I did not spend one dime on gambling. Last time I was in Las Vegas, I was there just to explore the city, go to some buffets. Third time I was been in Las Vegas, and each and every time I've been in that city, I did not make one single bet. So you can enjoy Las Vegas without gambling. Anyway, the whole point of this video is to test some of my biases that the Star Entertainment Group is not a growth company. Let's see if that is true. First step is looking at the market cap. Has that grown through time? And in fact, it has. It's gone from 2.8 billion in 2011 to 3.5 billion in 2021. Well, that's a good start. However, I would argue that's not a very big increase over a 10-year period, only a 25% increase, in fact, and that's fairly low growth rate. That's much lower than what you would want over a 10-year period. But if we turn our attention to revenue, profit, and operating cash flow, we do see some negative signs right there. In fact, revenue has dropped from 1.6 billion to 1.5 billion. Profits dropped from 226 million to 58 million, but operating cash flow has increased from 360 million to 464 million. Now, you might be saying, trying to argue, that Star Entertainment Group has been affected by COVID-19. More than likely, it has been affected, and that profit of 58 million more than likely has, there has been some one-offs there to lower that. But I went back to 2019 and compared 2019 to 2011, and still we don't see any growth in this company, or very slow growth at that. They do spend a fair bit of money on capital expenditure. That has dropped from 411 million to 102 million. I should mention right now that the Star Entertainment Group is building a casino in Brisbane, and that should be a success, you would think, but most people in the world don't associate Brisbane and casinos. So I think that's just going to be not big business, not a company-changing casino at all, in my opinion. They do have $1.2 billion of net debt, so that is fairly high for a company with a market cap of 3.5 billion. So that's a massive red cross in my books. Now let's turn our attention to some of the valuation metrics. And again, what I'm looking for here is the valuation metrics to be lower to what you would find in the historical range. Price to operating cash flow, 7.5, is in historical range. Let's ignore the P/E ratio because one-offs have driven that profit down, but P/E ratio right now is at 60. And historically, the P/E ratio for the Star Entertainment Group is between 15 and 25. And that seems a little bit high for a non-growth company. And the Star Entertainment Group is, in my opinion, a non-growth company. I haven't changed my opinion looking at these numbers. And the price to book ratio, 0.97, right in the range, historical range of between 0.9 and 1.2. So no reason to buy into this company right now based off valuation. This company is not a growth company. So at this point in time, I still remain uninterested in this company. And if we look at the weekly chart for the Star Entertainment Group, over the past 10 years since they listed on the ASX, and nothing to be excited. In fact, the share price back when they listed was right about $3, and actually about $4, and the share price now is $3.73. So the share price over the past 10 years, or since they listed, has actually gone down. So even though the market cap has gone up, capital raisings has led to dilution, and that dilution has meant the share price has actually dropped over that time period. And straight away, that should tell you that this company is not an investable company. The only time you might be thinking of investing in this company is when the share price gets really low and there is some possible value there, just like during the COVID-19 financial panic, when the share price of this company got down to $1.60, maybe even during 2013 when the share price got down to about $2.25. Share price has been as high as $6.40 during 2018, but there's no trend in the share price. Share price has been going sideways, up and down. Some of these issues did drive the share price down a few weeks ago. No reason to make an investment in this company at this point in time because of valuation, no uptrend in the share price. I'm not sure why you're buying this company right now. If you do have a position in this company and you think or are bullish about the Star Entertainment Group, I'd love to hear your opinions because your opinions will be completely different than mine, and I'd like to see someone try to challenge my opinion. So if you are bullish about the Star Entertainment Group, maybe you think Brisbane Casino will be a raging success and this company will go simply because of that casino. I'd love to hear your opinions just to challenge mine. I did have some fairly strong opinions or biases against or for the first 5 companies in this video. In the next video, the 5 companies I'll be featuring, my biases aren't that strong either way, apart from maybe Seek. I do think Seek is quite overvalued right now. I am fairly high on JB Hi-Fi for the long term. In fact, I was thinking of discarding JB Hi-Fi simply because I have been a shareholder of that company and I do have a fairly strong opinion about that company. The other 3 companies, Perseus, Platinum Asset Management, and Orica, I have very little opinions about those 3 companies at all. So I'm not sure what I'm going to challenge, but Perseus is a gold mining company, and I actually am fairly bullish about the long-term play on gold. And Orica, I'm not even sure what they do. So it's going to be really interesting as I do a little bit of research on that company. They might be a mining services company. I'm actually a little bit unsure. And Platinum Asset Management, those sort of companies, I've never really been interested in investing in those sort of fund managing sort of companies. So it's going to be interesting to do a little bit of research on Platinum Asset Management. That's it for part 1 to these 10 stocks to buy, looking at 10 random companies or 5 random companies on the ASX 200. Hope you are able to join me for part 2, which I should be releasing in the next week. Now, in regards to the 5 companies I did feature in this video, I do think, even though I challenged my biases, a lot of my biases did hold true. In particular, in regards to Breville, which I am fairly high pro, and in regards to Woodside and the Star Entertainment Group, which I don't think are growth companies, and I do think I sort of proved that in this video. If you do have any questions about these 5 companies or any other companies on the ASX, please leave your opinions, your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.